day, everyone, and welcome back to the channel. If you've ever looked at the stock market and thought, where on earth do I even begin? You're in the right place. It can seem super complicated, like a whole different language. But trust me, with the right approach, anyone can get started. Today, I'm breaking down 10 essential, no-nonsense tips to help you take your first steps into the world of investing. We're going to demystify the process and give you the confidence you need to get going. Ready to build your financial future? Let's dive in. First things first, and this is non-negotiable. Define your financial goals. Why are you investing? Are you saving for a down payment on a house in 5 years? Planning for retirement in 30 years? Or maybe you just want to grow your wealth over the long term? Your goals will determine your entire strategy. Someone investing for a short-term goal will have a very different approach than someone investing for retirement. A short timeline might mean you need to be more conservative, while a longer timeline allows you to ride out the market's ups and downs. So, grab a notebook, sit down, and get really clear on what you're working towards. It's the foundation for everything that comes next. Tip number 2 is all about education. Before you invest a single dollar, you need to understand the basics. You don't need a PhD in finance, but you should know what a stock is, what a bond is, what an ETF or a mutual fund is. Understand key terms like diversification, asset allocation, and risk tolerance. There are so many incredible free resources out there. You can read books, listen to podcasts, watch reputable financial news channels, and, of course, follow channels like this one. The more you learn, the less intimidating it all becomes, and the better equipped you'll be to make informed decisions instead of just guessing or following hype. Knowledge truly is power, especially in investing. Alright, let's talk about something that trips up a lot of new investors: understanding your risk tolerance. This is basically figuring out how much you're willing to potentially lose in exchange for the chance of higher returns. Are you the type of person who would panic and sell everything if the market dropped 10%? Or can you stomach the volatility for the potential of long-term growth? Be honest with yourself. Your age, your financial stability, and your personality all play a role. Generally, the younger you are, the more risk you can afford to take because you have more time to recover from downturns. There are plenty of online questionnaires that can help you gauge your risk tolerance. Knowing this will guide you toward the right mix of investments for your comfort level. Now for one of the most important concepts in investing: diversification. You've probably heard the saying, don't put all your eggs in one basket. That is exactly what diversification is. Instead of betting everything on one or two individual stocks, you spread your money across many different investments. This can include different companies, different industries like tech, healthcare, and consumer goods, and even different types of assets like stocks, bonds, and real estate. Why is this so crucial? Because if one part of your portfolio is having a bad year, another part might be doing well, which helps to balance things out and reduce your overall risk. It's the key to building a resilient, long-term portfolio. Tip number 5 is a simple one, but so powerful. Start small. You do not need thousands of dollars to begin investing. In fact, it's better if you don't start with a huge amount. Thanks to modern brokerage apps, you can often start with as little as $5 or $10. Many platforms now offer fractional shares, which means you can buy a small piece of an expensive stock, like Amazon or Google, without having to afford a full share. Starting small lets you get your feet wet, learn the process, and see how you react to market movements without putting your life savings on the line. As you gain more knowledge and confidence, you can gradually increase the amount you invest. It's a marathon, not a sprint. This next tip is for everyone who loves a good shortcut. Consider starting with index funds or ETFs. Instead of trying to pick individual winning stocks, which is incredibly difficult even for professionals, you can buy a whole basket of them at once. An S&P 500 index fund, for example, lets you invest in the 500 largest companies in the US with a single purchase. This instantly diversifies your portfolio and allows you to just match the market's performance over time. ETFs, or exchange-traded funds, work similarly. They are low-cost, easy to buy and sell, and are a fantastic way for beginners to get broad market exposure without the headache of stock picking. It's a smart, simple, and proven strategy. Let's talk about the magic of consistency. Tip number 7 is to automate your investments. The best way to build wealth over time is through a strategy called dollar-cost averaging. This just means investing a fixed amount of money at regular intervals, say $100 every month, regardless of what the market is doing. When the market is down, your fixed amount buys more shares. When it's up, it buys fewer. Over time, this averages out your purchase price and reduces the risk of investing a large sum at the wrong time. The easiest way to do this is to set up automatic transfers from your bank account to your brokerage account. Set it and forget it. This disciplined approach removes emotion from the equation and builds a powerful habit. Tip number 8 is a mental game, but it's critical. Think long term. The stock market is not a get-rich-quick scheme. It will go up and it will go down. There will be scary headlines and market corrections. The key to success is to stay the course and not panic sell during a downturn. History has shown that over the long run, the market has consistently trended upwards. Trying to time the market, selling at the peak and buying at the bottom is nearly impossible. Instead, focus on time in the market, adopt a long-term perspective, trust your strategy, and let the power of compounding work its magic over years and even decades. Patience is your greatest asset as an investor. Okay, we're almost at the end. Tip number 9 is to keep your costs and fees low. Fees might seem small, but they can eat away at your returns over time and have a huge impact on your portfolio's growth. When you're choosing a brokerage platform or an investment fund, pay close attention to the fees. Look for brokerages that offer commission-free trades. When investing in ETFs or mutual funds, check the expense ratio. This is the annual fee the fund charges. You want to find funds with very low expense ratios, ideally below 0.2%. Every dollar you save in fees is another dollar that stays invested and working for you. And finally, tip number 10, review and rebalance your portfolio, but don't obsess over it. It's a good idea to check in on your investments periodically, maybe once or twice a year, to make sure your asset allocation still aligns with your goals. For example, if your stocks have performed really well, they might now make up a larger percentage of your portfolio than you originally intended. Rebalancing means selling some of the winners and buying more of the underperforming assets to get back to your target mix. However, this doesn't mean you should be checking your portfolio every single day. That's a recipe for anxiety and emotional decision-making. Set a schedule, stick to it, and let your investments do their thing the rest of the time. So there you have it, 10 essential tips to get you started on your investing journey. Let's do a quick recap. Define your goals, educate yourself, know your risk tolerance, diversify your holdings, start small, consider index funds, automate your contributions, think long-term, keep fees low, and review periodically. Investing is one of the most powerful tools you have for building a secure financial future. It takes a little bit of learning and a lot of patience, but you can absolutely do it. Thank you so much for watching. I hope you found this guide helpful and feel more confident about getting started. If you have any questions, please drop them in the comments below. I love hearing from you. And if you got value from this video, please give it a thumbs up and consider subscribing for more content to help you master your money. See you in the next video.